Before you sell the family home in retirement, ask yourself one question. Are you really unlocking money, or are you turning your safest asset into the most exposed money you own? Because for many UK pensioners, downsizing sounds like freedom, a smaller house, less cleaning, lower bills, no stairs, a little cash in the bank, maybe something left over for the children. But once the move is complete, some people discover something painful. Before we continue, hit like and subscribe my channel for more retirement, pension, HMRC, and personal finance updates that could help you protect your wealth and enjoy a better retirement. The house they sold was protected in ways they never understood. The cash they created is not. And that single difference can change everything: your tax position, your benefits, your care costs, and even what your family eventually inherits. Now, this is not a video telling every pensioner to stay in a house that no longer works for them. Sometimes downsizing is absolutely the right decision. If the stairs are unsafe, if the garden is too much, if you are isolated, if the heating bills are crushing you, or if moving closer to family gives you peace of mind, then moving may be worth every penny. But what you must not do is downsize, because someone has done a simple calculation on the back of an envelope. They sell for £500,000, buy for £300,000, and keep £200,000. That sounds obvious, but in real life, retirement money does not work that cleanly. So today, let's break down the hidden downsizing trap in plain English. Not panic, not hype, just the reality many people only discover after they have already sold. Imagine a retired homeowner called Margaret. She is 71. She lives alone in the house she bought decades ago with her husband. The children have moved out. Her husband has passed away. The spare rooms are mostly storage. The garden is harder to manage. The stairs are becoming annoying. Her daughter says, "Mom, why are you still in this big place? Sell it, buy a smaller bungalow. Keep the difference. Enjoy your retirement." And Margaret thinks that makes sense. Her home is worth £500,000. The bungalow she likes is £300,000. So in her mind, she has just created £200,000. But that is the first mistake. Because the money you think you are freeing up is not the money you actually keep. First come the selling costs, estate agent fees, solicitor fees, searches, conveyancing, survey costs, removal costs, storage, repairs before sale, new carpets, new furniture, maybe adaptations in the new place. A retirement move is rarely just sell one house, buy another. It is a chain of costs. And then comes the tax many older homeowners forget about because they have not bought property for 30 or 40 years. Stamp duty, land tax. In England and Northern Ireland, if you buy a residential property for £300,000 as your main home, the standard SDLT calculation is based on bands. Nothing on the first £125,000. 2% on the next slice, up to £250,000. 5% on the slice above £250,000. That creates a £5,000 stamp duty bill on a £300,000 purchase. So before Margaret is even unpacked, thousands have disappeared. And this is the moment many retirees feel the first shock. They thought they were creating a clean £200,000 cushion. But the transaction itself may have swallowed £10,000, £15,000 or more. Now some people will say, fine, but she still has a large lump sum. That is good. And yes, having savings is better than having no savings. But here is the part people often miss. Your main home and cash in the bank are treated very differently. Your home can rise in value for years, and in many cases, if it has been your only or main residence, you may not pay capital gains tax when you sell it. That is one of the biggest protections ordinary homeowners have. But once you sell, the wealth changes form. It is no longer a roof over your head. It becomes capital. It becomes savings. It becomes visible money. And visible money can affect other parts of retirement life. Let's talk about pension credit. Many pensioners wrongly assume they either qualify or they do not. But savings can change the calculation. Under pension credit rules, savings of £10,000 or less do not affect the claim. But above £10,000, the system assumes income from that capital. For every £500 above £10,000, £1 a week is counted as income. That does not mean you actually receive that much interest. It means the benefit system treats you as if you do. So if someone suddenly has £100,000 or £150,000 in the bank after downsizing, that can seriously reduce or wipe out entitlement to support. And pension credit is not just one payment. It can be a gateway to other help. Council tax support, help with health costs, cold weather payments, other forms of support that make life easier for people on lower incomes. So the question is not just how much cash did you release, the question is what support did that cash quietly remove? Now let's move to the second major issue, care costs. This is where many families get caught. When you live in your own home, the way your property is treated in care assessments can be complicated. There are rules, disregards, protections, and circumstances that matter. But cash in the bank is much simpler. It is counted. If you need care later, especially residential care, savings and capital may be assessed. In England, the upper capital limit for local authority support remains £23,250 for 2026 to 2027. So if Margaret has £180,000 sitting in savings after downsizing, she may be expected to use that money toward care costs until it falls significantly. That is not a small detail. That can be the difference between money staying protected inside a home and money being drawn down year after year. And this is where some families make a dangerous mistake. They say, well, just give the money to the children. But if the purpose is to reduce care fees or qualify for benefits, that can be treated as deliberate deprivation of assets. In plain English, the council may say, we still count that money as yours, so the gift may not solve the problem. It may simply create a family dispute, a financial mess, and an assessment that treats the money as if it never left. This is why downsizing must be planned before the house goes on the market, not after. Now, let's be fair. There is also a myth in the other direction. Some people panic and think, if I downsize, I will destroy my inheritance tax position. That is not always true. The residence nil rate ban can allow an additional inheritance tax threshold when a home is left to direct descendants, such as children or grandchildren. And if someone downsized or sold a home after the 8th of July 2015, there may be a downsizing addition available, provided the conditions are met and assets of equivalent value pass to direct descendants. So downsizing does not automatically ruin inheritance planning, but it does make paperwork and planning more important. Your executors may need to claim the right allowance. Records matter. Dates matter. Values matter. Who inherits matters. So again, the issue is not simply downsizing is bad. The issue is this: downsizing without understanding the rules can be expensive. Now let's step back and look at the bigger picture. Why does this mistake happen so often? Because families focus on the visible benefit: a smaller home, a cash lump sum, less maintenance, a fresh start, but they ignore the invisible costs: stamp duty, moving costs, lost benefit entitlement, taxable savings interest, care fee exposure, inheritance paperwork, emotional loss, and that emotional loss should not be dismissed. A family home is not just an asset, it is where birthdays happened, where children grew up, where a spouse may have spent their final years, where memories live in every room. So when someone says just sell it, they may be thinking logically. But for the person living there, it is not just a property decision, it is a life decision. That is why the worst downsizing advice is usually the simplest: sell and free up the money. Because the real question is not whether you can free up money. The real question is whether freeing up that money improves your life after all costs are counted. So here is a better test. Before downsizing, ask 5 questions. Question 1. What is the true cost of the move? Not just the sale price and purchase price. Add estate agent fees, solicitor fees, surveys, removals, stamp duty, storage, repairs, furniture, and emergency costs. Write down the real number. Question 2. What will the lump sum do to your income position? Will it affect pension credit? Will it reduce council tax support? Will the interest become taxable? Will it push you into a different financial position? Question 3. What happens if care is needed later? Will the cash be assessed? Would staying put give you better protection? Could adaptations, stair lifts, home help, or moving later be better than selling now? Question 4. What is the inheritance plan? Who will inherit? Could the residence nil rate ban apply? Will downsizing addition records be kept? Has proper advice been taken? Question 5. What is the non-financial reason for moving? If the answer is safety, health, family support, loneliness, or quality of life, downsizing may be sensible. But if the only reason is the house is worth a lot, pause. A valuable home is not the same thing as wasted money. Sometimes it is protection, sometimes it is stability. Sometimes it is the one asset the system has not yet touched. Now let's make this practical. If you are thinking of downsizing, do not start with an estate agent. Start with a notebook. Write the value of your current home, write the price of the property you want to buy, then deduct every cost you can think of, then ask how much cash is really left. Then speak to someone who understands your situation. That might mean a qualified financial advisor, an accountant, Citizens Advice, PensionWise through Money Helper, or a benefits advisor if you rely on any support. The key is this: get advice before the decision becomes irreversible, because once the house is sold, the money has changed form. And once the money has changed form, the rules around it may change too. So should you never downsize? No. That would be too simple. A smaller, safer, warmer home can be one of the best decisions of retirement. But should you downsize just because your children say it makes sense? No. Should you assume the difference between two house prices is what you keep? Absolutely not. Should you understand how stamp duty, savings, benefits, care fees, and inheritance rules interact before you move? Yes. Because the real retirement trap is not the small bungalow. It is the belief that selling a tax-efficient home automatically makes you richer. Sometimes it does, sometimes it does not, and the difference depends on planning. So before you sell the home you spent decades building, slow down, do the full calculation, get proper guidance, and make the decision because it is right for your life, not because someone else made it sound easy. If this helped you see the bigger picture, please like the video and subscribe for more clear, practical updates for UK pensioners and retirees. And tell me in the comments, have you or someone in your family considered downsizing? And did the numbers turn out the way you expected? Your experience could help someone else avoid a very expensive mistake.